The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Welcome back. We have a listener's question today, which is so exciting. Let's have a quick listen.
Hi girls, I was just wondering if investing in VDHG long term is a good option, roughly putting about $200 in a fortnight.
That is such a good question. We get asked that quite often. I feel like it's a very good one.
Yeah, often we have questions around a specific share like VDHG or how people should make their portfolio together. So let's break down some of this stuff. But before we do, should we talk about our money moments of the week?
Money moments? Yes. What is yours?
Mine is my partner, we as a family collectively spent $235. We bought 2 cameras and little solar chargers for these cameras to put at the front and the back of our house.
Oh, like security cameras?
Yeah. So I live in a fairly safe neighborhood, but there have been some younger humans going around stealing cars and doing random things. And a couple people have decided to put cameras up in the neighborhood. And I thought, hey, it's not a bad idea. Why don't we do this? So I suggested this. And my partner is very much into doing a lot of research and coming back with the best options. And this goes for all of our appliances. So anyone who's friends with me often will be like, what does your partner think about coffee machines or whatever? Because my partner's done the research already on it. So we came back with a couple options and they all had slightly different pros and cons. One of the things I didn't realize is that often cameras will charge you for a subscription to record what's happening, which blew my mind. And that was something that we did not want. We didn't want to be on a subscription model where we're paying for the security for this camera, for this footage. To be living in a cloud, we wanted to have access on that to that easily. So we settled on one and got it installed. And sure enough, guess what happened the next day? Someone who's probably around the age of 12 to 13 rang our doorbell and then ran off. And the exact same thing happened the next day. So I've got this kid on camera and yeah, who would have thought? You set up a camera and literally that happens the next day.
Crazy. Usually it's something you buy something just in case, then it never happens. But yeah, good timing for you.
Yeah.
Now that I'm thinking about it, I think the Ring doorbells have gotten really popular, the doorbells with the camera on them, but I think they also come with a subscription. So definitely a good thing to consider about the ongoing costs because these things are pretty expensive to buy straight up, aren't they?
Yeah. I mean, this wasn't too bad, like $235. If you get like one of those fully installed ones, they're a couple $1,000s and we were debating whether we wanted like a full system. So this was just the one that we landed on. But yeah, subscription is a crazy thing because imagine if you're going to have that for 20 years or more, how much are you paying and depending on the setup of that?
Yeah, I was talking to someone the other day about like the Aura rings and like the Whoop like health tracking devices. And in Australia, they're like $800 to $900, the Aura ring, I think, once you convert it from US dollars. But then you also have to pay the ongoing subscription as well, which just seems so pricey once you add it all up.
Yeah. And already we have subscriptions for things like, Google or Apple
storage,
or whatever
emails.
It is. Storage. Yeah. It adds up. And it kind of blows my mind. I read a book recently that was talking about how we'll have less ownership on things. Like we pay for our music, we pay for Spotify, but we don't own CDs or DVDs anymore the way that we used to. So that's such an interesting thing when it comes to paying for stuff.
Yeah, and it's hard once you've started committing to something like storage, especially changing your mind and being like, oh, do I have to download everything onto like a hard drive to not have that subscription anymore? Like it really traps you in there.
Yeah, for sure. Anyways, that was our money win, I guess, of the week. What about yours?
Mine was very exciting. A little while ago, I had Virgin reach out asking if I wanted to be part of their first flight to Uluru, which is so exciting. I had a few questions on Instagram about how these trips kind of work. So I thought I'd share this as my money win of the week. With the trip, they emailed me and asked if I wanted to come in exchange for sharing my experience on social media. So they paid for my flights, my hotel, the activities as well, which was so awesome. And it was such a fun experience. And then in exchange, we had to share stories and a post about what we got up to on the trip.
Did they say how much? Like, did they say you have to post this many posts and this many reels?
Yes, they said a minimum of 2 stories per day, so 6 stories in total. The funny thing was the reception went out, so we didn't have any like phone or internet for the first 24 hours, which was interesting. It was actually quite nice being disconnected. But yeah, just the 6 and then the reel, but it could kind of be anything that you wanted. So I did a few just about Uluru, but then I used heaps of Uluru ones for the backgrounds of my Q&A posts because I didn't want to just like overwhelm everyone with like random Uluru content. So I tried to make it helpful as well still. But yeah, that was such a big money win because I got like essentially a free trip for a little bit of social media work that I was going to do anyway.
Yeah, and you probably got to connect with a bunch of awesome people who are doing similar things without internet, which is the irony of the whole situation. And Uluru is such a sacred and special place.
Mm-hmm. Yeah, it was great to be part of it.
Yeah, for sure. Oh, what a cool experience. All of the things that you don't know when you see content creators going on trips, like how does that work and so forth. So, yeah.
I've always wondered if they get paid. So I didn't get paid on this one and they weren't paying most people that I heard of, but I've always wondered when you see people doing stuff, you're like, oh, are they getting paid to be there? Is it just a free trip? Like what's the situation? But this one was mostly unpaid from what I heard from others as well.
When you connect with other people there, do you actually like have those money conversations? I know like you come from a money background. Yeah, I was going to say, do other people talk about that? Like how much sponsorship goes or whether they got paid or not for X, Y, and Z? Or
yeah, some people are still a little bit like not comfortable sharing, which is fine. And I think because it's not a very standardized industry, people charge so many different rates and it's really hard to figure out what to charge yourself. So I definitely talk about it. There are some people who talk to me about it as well, but some people still don't quite want to, which is completely fine. But it's a hard one when I don't quite know these people very well to feel like, were you paid to come here? So like I asked a few that I became friends with, but yeah, it's a bit of a hard one because it's still not completely normalized to share in this industry.
Yeah. And it also kind of depends, I guess, on how many followers you have, what your reach is, and all of those things are so hard to kind of properly calculate.
Yeah.
Right?
What your audience is as well. Like being in finance, you can charge a little bit more than like a lifestyle creator, for example, because my audience is a little bit older. They're mostly based in Australia, just stuff like that. Whereas like if you're selling like a lipstick or a lip gloss or some clothes, your audience is often worth a little bit less compared to finance products or the companies don't have the same level of budget. But yeah, even just the type of product ranges so much with what you can get paid.
Yeah, all that stuff really blows my mind. I think for social, I once got $50 for a social post. So that was very exciting for me. That is the only time I've monetized my social media. So I'm living vicariously through your experience and your stories, Tash.
Yes. Well, I guess in like the end, Uluru ended up costing me a little bit of money in terms of like paying for extra things and Ubers to the airport. And like, I think I sent 50 emails just trying to organize the trip. So it's definitely like extra work in there too, but still so grateful I got to go.
Yeah, for sure. I think like those free trips and experiences and people you're connecting with is invaluable in many ways.
So worth it.
Cool. So let's talk VDHG. What is it and how can you invest in it? So let's dive into this.
So it is the Vanguard Diversified High Growth Index ETF, lots of words in there, but it's essentially just a basket of shares. There's 16,000 companies in VDHG, which is huge, and it's 90% growth assets, so things like shares, and 10% defensive or income producing assets, so things like bonds and fixed interest. So let's dive into what it actually invests in. I know it's an ETF, so a fund that actually holds 7 different funds, but it's by something called Vanguard. What actually is Vanguard?
So Vanguard is a fund manager that essentially has a bunch of different funds under its name. And the cool thing about VDHG is that it holds 7 different Vanguard funds already. So the ones that it does hold is the Australian Shares Index Fund, International Shares Index Fund, International Shares Index Fund Hedged, Global Aggregated Bonds Index Fund Hedged, International Small Caps Index Fund, Emerging Markets Index, and Australian Fixed Interest. So you can invest in those specific funds if you want, but you can also hold all of them.
So for example, the Australian one is equivalent to VAS, which is the ASX 300. So it includes the top 300 companies in Australia, including things like BHP, CommBank, and NAB. For international, it includes around That international fund is equivalent to VGS, the ETF you may have heard of. So this invests in around 1,500 companies, including things like Microsoft, Apple, Nvidia, and it's from developed countries, but not Australia. So it also includes like places in Europe maybe, or the US as well. There's also a few others like hedged. That's something that tries to protect against currency fluctuations, because obviously if you're investing in America or in other places in Europe, there are currency differences and they move separate to Australia. So that's what they're trying to do. And then there's also some fixed interest things. What's the point of the fixed interest funds?
Well, the big thing around that is that it reduces volatility. So it's also seen as a defensive asset. And we often talk about bonds or cash as being defensive assets, whereas often if shares are going down, bonds and cash can potentially go up in interest. So it's just a different way of balancing your funds so that you kind of can go through the volatility less volatile.
And it's considered high growth because it's only 10% of those defensive assets and the rest is in high growth shares. Another question I often get asked is, should you buy VAS and VDHG together? But if you dive into what's actually in VDHG, you can see that VAS is the equivalent to the Vanguard Australian Shares Index Fund. So with VDHG, it invests into other managed funds, technically not into the ETFs, but they're the equivalent anyway of the matching ETF. So if you're deciding whether to buy just VDHG or VDHG and VAS, have a look at what you're actually investing in within those ETFs to see.
Yeah, because in this situation, 36% is already invested in VAS. So do you think that you need more exposure to Australian shares, or is that enough for you?
Going on to fees, VDHG has a management fee of 0.27% per year, but this fee is on top of all the underlying fees of the managed funds as well. So it is a little bit more expensive in terms of management fees to buy something like VDHG rather than managing it yourself, but you don't have to do things like trying to rebalance or trying to make sure you've got all the funds. And also it costs a lot in brokerage fees to buy so many different funds as well.
Very true. The recommended time frame for investing in VDHG is around 7+ years. It is considered high risk, as a lot of investment products are. You are investing in shares and specific companies that these indexes follow as well. So it's just something to be aware of when you're looking at your time frame and goals.
If you're wondering why they usually say 7 or 10+ years, it's to hopefully be able to ride out any market crashes if they do occur. So generally market crashes are normal and they do happen as part of the investing cycle and the investing economy. So with the 7+ time frame, we're kind of hoping we'll be able to ride the wave just in case it does crash temporarily.
So if you're thinking about dividends or distributions, as they're most commonly used when talking about ETFs, they are paid out quarterly, which is really great. So that means you'll see something in your bank account 4 times a year.
If you want to know the exact amount that they pay, you can always just type in VDHG dividends or distributions and you can see the history of those pretty easily. There's 2 kind of main ways I think you can buy these. The first one is Perla. Do you want to tell us a little bit about that, Anna?
Yeah. So Perla is a wealth management platform, and you can pay the brokerage fee of $6.50, or if you prepay, that's $5.50, and you can invest directly into VDHG.
I think it's a minimum of $500 initially, but you do want to be mindful of investing enough to make up the brokerage fees, I guess. So what did our listener say? They're investing $200 a fortnight. What I do with Perla on my auto invest is it will direct debit $200 a week from my bank account, but then it will only invest once that amount reaches $1,000. So that way I'm not paying the $5.50 brokerage fee every single week. I'm just paying it every 5 weeks or so. So that might be an option for this listener who's doing $200 a fortnight.
The other thing that this listener can do is check out an investment frequency calculator, which is a really great way to look up when's the optimal time to invest, what frequency, how much you should do it, and what the brokerage fee is. So that's something to be mindful of as well. If that amount changes in the future, or you just want to see what's the best bang for buck you can get when it comes to investing.
There's also Vanguard Personal Investor, which might be a good option if you're just buying Vanguard ETFs. So they do charge you a brokerage fee if you're buying a non-Vanguard investment, but if you're just buying a Vanguard one, it does come with $0 brokerage. There's just a $9 fee to sell eventually later. I tried Vanguard Personal Investor a few years ago. I don't know if it's gotten any better now, but it was very clunky and hard to use and really hard to find information. So you could even sign up to both. Sign up to Vanguard, sign up to Perla and see which one works for you. But if you're looking for low fees, maybe the Vanguard and Personal Investor is a good option.
And there are other brokers as well out there if these two don't suit you. So just make sure to read the PDS and know what you're investing in.
And don't spend too long trying to find a broker. I like to say what you buy matters more than where you buy it. So the ETF you're buying matters way more than whether you buy it at Vanguard, Personal Investor or Pearler. So feel free to sign up to a few and find one that works for you.
I've had a few people reach out to me and often contemplate between two different investing strategies. For example, should they invest in VDHG or should it be something like DHHF or other Vanguard funds and so forth? So maybe right now would be a really good opportunity to talk about some of these differences because analysis paralysis is a real thing. And as we know, like sometimes just getting into the market is a great way because you can learn and grow as you start investing.
I started off buying VDHG actually because it's a very popular one. You might see it spoken about on Reddit, for example, or in Facebook groups. Lots of people are big fans. But I actually switched over to buying DHHF instead. So that's the BetaShares Diversified All Growth ETF. The reason I did this is because I didn't want the 10% allocation to bonds and fixed interest. I have a lot of money in my emergency fund and in my savings accounts. I own some bonds from buying them in previous lifetimes as well. They're just kind of sitting there too. So now I just buy the BetaShares ETF instead. I think they're both really good options, but they are different still. Like the BetaShares one only invests in 4 funds instead of 7. So you're missing out on some of that exposure. And I think there's only 8,000 companies instead of 16,000. So it is half of the companies.
So yeah, it invests in a little bit less. And also the management fees and cost is 0.19%.
Yes, a little bit less, which is good. But it is a little bit more high risk than the Vanguard high growth diversified one. So just something to keep in mind there. If you're looking for something that's a little bit less high growth, Vanguard has so many other options. Like their one down from the high growth is just the growth one, VDGR. So that's 70% growth and 30% defensive assets. There's also a few ways to kind of DIY, do it yourself. So if you don't want an all-in-one diversified ones, people often buy like these ETFs together. So the first pair that's really popular, Anna, is
VAS and VGS. So that's the Australian Shares Index that we talked about previously, and the Vanguard MSCI Index International Shares ETF. So the cool thing is that you can actually invest in Australian shares and also have an international share portfolio. So you can decide what allocation you want of both. So as we talked about previously, what was it, around 36% that were in Australian shares? What if you want 50%? This is a way for you to be able to adjust your portfolio so that you can choose how much you want to be invested internationally and how much in Australia specifically.
Another popular option that I've seen together is VAS, like we just spoke about, the Australian one, and then VEU, which is the Vanguard All World excluding US, and then VTS, which is the Vanguard US Total Share Market ETF. So that one, instead of just having the top 500, has the total US market, which is pretty cool. That's quite a popular one to buy together as well.
And a reason why some people really like this specifically is because the US has one of the biggest economies in the world, and therefore they might be more interested in having a larger proportion or a smaller proportion of their portfolio invested in the US. And also because Australia does have things like franking credits, which can be really beneficial to anyone who's investing, you can then choose what allocation you want, whether you do want the 36% that is offered by VDHG or a different percentage as well. So this is why people do DIY style investing. And I think this is actually kind of how I do my investing as well, to adjust what works for my time frame and my goals as well.
I used to try and do this, but then I found I was tinkering with it too much. Like every time I logged on, I just feel like, oh, there's a new ETF to buy. What about this one that's like 0.01% less management fees? Like I was getting too distracted by it all. So I've just picked a diversified one now to make it easier for me. But a lot of people do just do it themselves, and that's a completely fine option.
So Tash, do you now just invest in one ETF?
Yeah, just in that BetaShares, like the VDHG's All Growth one. So I still have all of my previous ones. Like I still have VDHG. I still have all of the individual ones too. But yeah, now I just actively buy one because I was spending too much time fiddling with it, which isn't ideal. And I've bought way too many ETFs. There's always like a slightly better strategy or a slightly better thing you can change. But you know, it's taking up too much time.
But the question is it better, right? Like when I first started investing, I think I was telling you before that I bought like small caps, so smaller companies, and large cap, large companies, and REITs, which are real estate investment trusts. And I wanted to hold it all. I literally bought everything where I could have just bought one ETF that held all of that, instead of me now being like, oh, how much am I going to allocate? How about 10% to bonds? And, you know, whatever the percentage was that I was playing with. So it just became a lot of DIY stuff when I first started investing with how many 10 ETFs or who knows how many I started with.
I kept getting stuck when I first started with how much to actually allocate to each of them. Like you see people say like, 30% to Australia. But I was always like, where are they getting these numbers? So when I was really new to investing, I would go through all of the super funds and their high growth portfolios to see their allocation to Australia, US, international, property, things like that. And also at robo-advice platforms. So StockSpot, you can go through their PDS to see which ETFs they buy and what percentage of them too. And also Raise as well. Like Raise has an ethical portfolio, for example. So you can go and stalk there and see which ETFs they buy. But I find that they're all pretty standard. Like most of them seem to allocate around like that 30 to 40% to Australia.
There's also ways to look at individual people and what they're investing in through Perler as well. So that's kind of cool because you can look at people's profiles and what they're invested in. Keep in mind that is, you don't always see everyone's whole portfolio, just kind of what they're investing in. So it is a good educational tool, but always do your due diligence and do your research before investing.
And if you're getting stuck and not actually investing because there's too much information, maybe a diversified ETF is for you. Maybe something to look into. You don't have to, definitely not. But I found I've definitely not invested sometimes because I'm trying to make the best possible portfolio, which doesn't even exist.
Exactly.
I was wondering when we were kind of planning out this episode, why exactly it's 30% to Australia. Like I've always heard it's the kind of the number we aim for, but I wasn't really sure why. So I had a bit of a Google and asked ChatGPT, and these were some of the reasons that came up for why, and they do make a lot of sense. But the first one is home bias.
So home bias means that you're favoring your domestic investments. So we all know our Woolies and our Qantas and all of the big companies in Australia. And a lot of people feel really comfortable investing in them. And this is something that is not uncommon. You hear it all across the world. I know when I was in Canada, often we talked about what percentage you're going to invest in Canadian companies. But when you think it over, both Canada and Australia are quite small countries in terms of our economy and GDP in comparison to somewhere like the US. So it's just something to be cognizant of when you are thinking about your home bias.
There's also franking credits if you're an Australian investing in Australian shares. So that's a very great fun tax benefit. And that's why some people might allocate more money towards Australian shares because that can be very beneficial.
The other thing to think about is the market characteristics. So Australia's market is quite unique in the fact that it has a lot of focus on banking, mining, and healthcare. And these sectors can provide strong dividends and the potential for growth, making them very attractive to investors.
Especially if you're investing in the US, where a lot of their biggest companies are all tech companies. Like if you think of Apple, Microsoft, Facebook, Nvidia, they're all kind of tech companies. So investing in Australia too, you've also got mining and banking and other things, which is great.
There's also the benefit of diversification. So while 30% may seem substantial, it allows for significant diversification into international shares, bonds, real estate, and other assets. So it can help manage some of that risk that you have when it comes to investing and potentially some opportunities for growth as well.
Apparently, financial advisors in Australia usually follow guidelines and frameworks around the allocation percentages based on performance and risk. So 30% to Australian shares is usually seen as a good balance between mitigating that risk while also taking advantage of our growth and our tax benefits as well and franking credits.
So going back to this listener's original question, it is just wondering if investing in VDHG long-term is a good option, roughly putting in $200 a fortnight. So Tash, what are your thoughts on this specifically?
To be a bit annoying, it's going to depend, obviously. Like we've just spoken about how VDHG is a good diversified ETF. It's reaching 16,000 companies, which is amazing. It's diversified across the world. But now you have to think about whether it's a good option for you. So we did mention earlier on that the recommended time frame is 7 years or longer. Is that the right time frame? Are you hoping to spend the money earlier or later? So that's definitely a thing to look into. And also where you're investing it as well. So yeah, sure, 200 fortnight sounds great. Where are you going to put that and how are you going to minimize your brokerage fees?
Yeah, that's exactly that. I love that we always say personal finance is personal, but really that's why we do this podcast, because we talk a little bit about all the different things you need to consider and whether it's right for you. So this is just another piece of your educational research that you're doing and you know what's best for you. And if you're not sure, do reach out to a financial professional, financial advisors, a tax accountant when you're doing this stuff to help you out.
But in summary, VDHG isn't like a meme coin, like what is it, Dogecoin or something like that. So VDHG by itself is a good, solid investment. It's just deciding whether it's right for you.
And that's all for today.
Okay, bye.
Bye. Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invests or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.